We are covering these 6 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on MCHP. Microchip Technology, a leader in smart, connected, and secure embedded control solutions, has just made a notable move in the capital markets, pricing a $1.35 billion offering of depository shares. Each of these shares represents a 1/20th interest in a new series of 7.5% series, a mandatory convertible preferred stock. At $50 per share, this offering aims to raise significant capital to help reduce Microchip's existing debt, including a chunk of its commercial paper program. If the underwriters fully exercise their option, the company could see up to $135 million more. What stands out here is how Microchip is managing its debt, taking a strategic approach to lower its financial burden with these new funds. The offering is expected to close by March 25, 2025, and the net proceeds will likely have a positive impact on the company's balance sheet, helping it stay on track for growth and stability. On top of that, Microchip is making strides in the electric two-wheeler E2W industry. Its new E2W ecosystem provides scalable solutions like advanced battery management systems, BMS, to help optimize electric scooters and bikes. These innovations are key as they improve performance, extend battery life, and enhance safety. It's another move showing Microchip's commitment to expanding its reach into high-growth sectors, positioning itself as a key player in the electric vehicle supply chain. For investors, this combination of debt management and sector expansion provides a sense of stability and growth potential. The debt reduction will free up resources, and the E2W solutions could open up new revenue streams. This announcement has the potential to give Microchip's stock a solid push, as these developments strengthen its position in both its core markets and emerging sectors. Our review on WOLF. Wolfspeed Incorporated is making some serious strides in the semiconductor industry, particularly with its focus on wide bandgap materials like silicon carbide, SiC, and gallium nitride GaN. These materials are crucial for high-power applications, making them ideal for industries like electric vehicles, EVs, renewable energy, fast-charging technology, and more. Wolfspeed offers a range of products, from SiC bare wafers and epitaxial layers to power devices like Schottky diodes and MOSFETs. These components are essential in industries that require high efficiency and durability, such as EVs and renewable energy systems. Lately, Wolfspeed has been on investors' radar because of its strong positioning in high-growth sectors like electric vehicles and renewable energy. With the shift towards more sustainable technology, there's an increased demand for power devices that can handle high energy loads without compromising efficiency. And that's exactly where Wolfspeed's products come in. They're not just supplying parts, they're providing the building blocks for next-gen technologies. Their SpeedVal Kit modular evaluation platform and Wolfpack SiC power modules are great examples of their ability to innovate and provide high-performance solutions to emerging markets. What's exciting about Wolfspeed right now is their potential to scale. With electric vehicles and renewable energy technologies expected to keep growing, the demand for silicon carbide and GaN materials is only going to rise. Wolfspeed is in a prime position to take advantage of that, but it all comes down to whether they can meet that demand. If they can scale up production without compromising quality, we could be looking at a strong period of growth for the company. For investors, this is definitely a stock to keep an eye on. As more industries shift toward electrification and sustainability, Wolfspeed's market share could continue to grow, boosting their stock performance along the way. All in all, if you're looking at companies that are key players in the clean energy transition, Wolfspeed is one that's well-positioned to lead the charge. Our review on BA. Boeing just pulled off a huge victory that could have a lasting impact on its stock performance, especially in the defense sector. The U.S. Air Force awarded them a $20 billion contract to design and build the next-generation F-47 fighter jet, set to replace Lockheed Martin's F-22 Raptor. This is a massive win, not only for Boeing, but also for their defense business, which has been making a serious push in recent years. The F-47 is expected to bring a new level of performance with upgrades in range, survivability, lethality, and adaptability, features that will make it a game-changer for the U.S. military. For Boeing, this contract isn't just about the immediate $20 billion. It's about the long-term potential. The F-47 could end up generating hundreds of billions of dollars over its multi-decade lifespan, and with foreign allies already expressing interest in purchasing the jet, the future looks bright. This is a huge blow for Lockheed Martin and Northrop Grumman, who were both contenders for the deal, and it's clear that Boeing has gained some serious ground in the competitive fighter jet market. For investors, this win could be a key turning point. The defense sector has been a critical growth area for Boeing, and this contract is a solid confirmation that their investments in next-gen technologies are paying off. If Boeing can capitalize on additional orders, especially from international markets, this could significantly boost their revenue stream over the coming years. It also signals that Boeing is gaining traction in the advanced aerospace market, potentially giving them an edge over rivals like Lockheed Martin, whose stock took a dip following this news. Ultimately, this development strengthens Boeing's position in a competitive market and could result in sustained growth for the company. For those keeping an eye on the aerospace sector, this win is a signal that Boeing's defense arm is on the rise, which could have positive implications for their stock moving forward. Our review on GERN. Geron Corporation is making strides in developing imetelstat, a first-in-class telomerase inhibitor targeting hematologic malignancies like myelodysplastic syndromes, MDS, and myelofibrosis, MF. The company is in the midst of several critical clinical trials, including a Phase 3 trial for relapsed/refractory MF and a Phase 1 combination therapy study for frontline MF. These studies are essential for proving imetelstat's potential to improve survival rates in these difficult-to-treat cancers, which makes an important development for both patients and investors alike. For Geron stock, the big focus right now is on the Phase 3 IMpactMF trial. If the data shows imetelstat can significantly extend survival for MF patients, it could be a game-changer for the company, as the current treatment for MF are limited. But Geron isn't stopping there. They're also testing imetelstat in other serious blood cancers, like acute myeloid leukemia, AML, which could expand its potential even further. If they can show that imetelstat works across multiple indications, it could position Geron as a major player in oncology. Of course, there's always risk with clinical trials, and if the data doesn't meet expectations, Geron stock could take a hit. But if the trials succeed, there's a lot of upside potential, especially in a space with limited treatment options. Investors need to keep an eye on these trial results, as they'll likely be the deciding factor for Geron's future. It's a high-risk, high-reward situation, but with the possibility of solid returns if they hit key milestones. Our review on UBER. Uber Technologies Incorporated is continuing to expand its presence in the delivery space with a new pilot program in partnership with Darden Restaurants. Following a successful rollout at Olive Garden, Darden is now testing on-demand delivery at Cheddar's Scratch Kitchen in 10 locations, allowing customers to order directly through the restaurant's website or app. This expansion comes on the heels of Uber's success with the initial launch, which has built strong momentum for the company in the restaurant delivery market. This partnership with Darden Restaurants is significant for Uber, as it shows the growing appeal of its Uber Direct service, which allows businesses to offer seamless delivery without the need for in-house logistics. As the pilot at Cheddar's progresses, there's potential for it to roll out more broadly across Darden's portfolio, which includes brands like Longhorn Steakhouse and Ruth's Chris Steakhouse. For Uber, this means tapping into a larger share of the restaurant delivery market, which continues to be a lucrative segment, especially with consumers increasingly relying on delivery services for convenience. From an investor's perspective, Uber's push into these diverse delivery offerings is a strong growth signal. The company is diversifying its business beyond ride-hailing into areas like groceries, alcohol, and now, restaurant meals. Uber's ability to integrate seamlessly with partners like Darden not only strengthens its market position, but also boosts confidence in its long-term growth prospects. Coupled with strong quarterly earnings and a solid return for shareholders, these developments are helping Uber gain traction in an increasingly competitive market. For investors, the expansion of Uber's delivery services is a key growth driver to watch. If the Cheddar's pilot proves successful and more Darden restaurants sign on, Uber could see increased revenues from this segment. It's another example of Uber diversifying its offerings and becoming an even more essential player in the delivery and logistics space, which could have positive long-term implications for its stock performance. Our review on GILD. Gilead Sciences Incorporated is making some significant strides with its expansion of Livdelzi, a medication designed for the treatment of primary biliary cholangitis, PBC, a chronic liver disease. Recently, the company received European marketing approval to expand the use of Livdelzi in this space, which is a big win for both the company and the patients in need of better treatment options. For Gilead, this approval marks another important step in diversifying its portfolio beyond its stronghold in HIV and hepatitis therapies. Livdelzi's approval for PBC is especially crucial as it's tapping into a relatively underserved market with limited effective treatment options. By bringing this treatment to the European market, Gilead could not only address a significant unmet need, but also open up a new revenue stream. The move aligns with the company's broader strategy to focus on rare and complex diseases, which could help solidify its position as a leader in specialty therapeutics. From an investor perspective, this is a positive development for Gilead. The approval boosts confidence in the company's ability to bring new treatments to market, which is essential for driving future growth, especially as some of its older blockbuster drugs face patent expirations. Livdelzi's success in the European market could be a solid growth driver, and if it sees similar success in other regions, it could provide a much-needed revenue boost. Overall, the approval of Livdelzi for PBC highlights Gilead's ongoing commitment to expanding its therapeutic reach and meeting patient needs in underserved areas. For investors, it's a sign that Gilead continues to innovate and has a strong pipeline, which could keep the stock performing well in the future. Please subscribe, give the video a like, and watch more from our playlist. Thanks.